Let's bring in our market panel. Joining us is Charlie Babinski of Ariel Investments and Victoria Fernandez of Crossmark Global Investments. Good afternoon to both of you. Charlie, I'm going to start with you because looking at your notes, you basically say that we're at a key moment here. We're at a tipping point in terms of the dynamic in the market and entering a new era, I would imagine, with higher rates for longer.
Yeah, and this is a very long-term tipping point, so it's just not 1 day or 1 hour. But we've had 40 years of declining interest rates. We've had 40 years of declining inflation or no inflation. And while going forward, we may not have 40 years of increasing rates, the 40 years of declining interest rates is over. And so what we have to do is to say what classes of assets have benefited from this declining interest rates over 40 years, what was helped by declining inflation, and therefore we got to be careful going forward. And so my list would probably be that things that have been helped have been clearly bonds and growth stocks are helped a lot by declining interest rates. Leveraged buyouts, venture capital, very much helped by declining interest rates. And so now I think going forward, we're going to at least have a neutral wind and maybe a headwind of increasing rates. What will increasing rates and inflation help? Probably commodities and my old favorite value stocks who are earning money in the short term and shouldn't be as hurt by increasing rates.
Okay, I want to get into those details a little bit more. But first, Victoria, your thoughts on this market here, whether we've seen capitulation, what it means for the rest of the year.
Well, I think, Morgan, we've seen it in some areas. I mean, we saw what happened to utilities earlier this week, but I'm not sure we've seen a full capitulation in the market as of yet. I know there was a lot of concern with yields moving up to the highs that we have seen. I think it's highest in 16 years or so. We did get that little reprieve today that you talked about, but I don't think we're done yet. I mean, you look historically, and the 10-year Treasury yield is typically 200 basis points over your inflation rate. So from where we sit currently, that means we still have a ways to go. If the Fed thinks they can get inflation back down to 2%, then okay, we're sitting around a 4% 10-year, but I think that's a long ways off. I think the market, and some of the reason we've seen the volatility we've seen, is the market coming to terms with the fact that we are going to have rates that are higher, north of 5% on the short end of the curve, close to 5% along the 10-year, and maybe a little bit over on the 30-year. So starting to see that re-steepening that everyone's been talking about in the yield curve, but I think it's the market coming to terms with that and realizing that our debt servicing cost has now surpassed 14% of revenue. Listen to Dan Clifton at Strategas. He talks about this and how that is a critical threshold point where the economy really turns to austerity. So I think we've got more volatility for the rest of this year coming.
Yeah, Dan Clifton was on the show talking about that yesterday, as a matter of fact, Victoria. Does that mean, and we've seen yields moving higher for a number of weeks, a number of months now, and I realize it's been a particularly big spike here just recently, but have stocks fully caught up? Are the valuations between these two asset classes, is it fair yet?
I wouldn't say that we're fair yet. If you look at where inflation is, we should see PEs around 16 times. Now, we've come down from 21, where we were previously, but we're still at around 18 times, and we're looking at earnings expectations of around 12% for next year. That seems really high to me. I don't think we will probably live up to that, so I think there's going to be some more re-rating that we're going to need to do on stocks. We're going to have to see some of those valuations come back down, and that is going to be part of the capitulation process that we're waiting for. I just don't think we're there yet. That could be the thorn in our side, though, of calling for a larger pullback. If earnings continue to surprise to the upside, that's just going to be more support for this economy, and I think we'll push the pullback or push the recession further into 2024.